We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Matt Fernley, Managing Editor at the Battery Materials Review and Head of Research for Westbeck Capital's Volta Energy Transition Fund. Thanks for joining me today, Matt.
Pleasure, Tom.
So you recently published a 5-part series called Inflation and the Energy Transition. So why are there a substantial number of drivers of high inflation associated with this energy transition? So why don't we kind of start around you kind of broke that, let's say that blog post into 5 parts. So why don't we start with the impact of the moratorium on oil and gas exploration?
Yeah, I mean, I think this is really at the crux of the issue. I understand where governments are going with regards to the energy transition and wanting to cut the amount of hydrocarbon production, but I just kind of feel that they've jumped the gun a bit. If you look at the demand environment and the supply environment, I think there is a general feeling that because EVs are going to take over the world, we're not going to need as much oil and gas as we have done previously. And that's true, but the timing is wrong. If you look at our EV sales forecast, in fact, anybody's EV sales forecast, ICE, so internal combustion engine vehicles, are still going to be the primary part of what we call the global car park, the global car fleet, until well into the middle of next decade. So it's, we're still going to have very strong and probably rising oil and gas demand. Yet a number of Western governments have put the brakes on oil and gas investment. And, that article was written some time ago, obviously with the developments of the last week with regards to the Russian invasion of Ukraine. We have even more issues with regards to energy security. Europe is very, very dependent on Europe is very, very dependent on Russian gas for its electricity and heating production. Russia is still a large exporter of oil. So we do have a very substantial situation where we've seen governments and investors crack down on the supply of hydrocarbons before the demand has actually slowed for hydrocarbons. So we then have a situation where we have a very, very substantial structural imbalance that is emerging now and will continue to grow over the next 5, 10, possibly even 15 years. And we really, we've already seen the impacts of that before the Ukraine event, and now it's even larger. I think the oil price is up, 5 to 10% during that time. A lot of analysts now are suggesting it could get to $120, $150 a barrel, some even suggesting it could go as high as $200 a barrel. Gas hasn't been such an issue in North America, but I can tell you in Europe, it's been absolutely horrific. The gas price is up 200 or 300%. And, household gas prices are going up considerably, and industrial gas prices are going up considerably. And that's putting a lot of pressure on the industrial supply chain in Europe.
And as you're kind of pointing out, that raw product cost ends up getting passed along in the cost of everything else. And
I mean, that cascades down the supply chain. So, straight out for you and me as consumers, if we drive cars, the higher cost of fuel is going to have a direct impact on our money in our pocket. But even more than that, the energy cost, the heating cost of those of us who live in the Northern Hemisphere is quite substantial. And then on top of that, the industrial supply chain, if it costs me more to make steel, then I'm going to pass that cost on down to my consumers, who might be auto producers, they might be consumer products producers. Then you as a consumer are going to pay more for for those products going forward. And I think a lot of people forget this, but oil and gas are key components of petrochemicals, and chemicals are key components of manufactured goods. So we really are going to see a huge cascade effect down the supply chain from higher oil and gas prices.
Mm-hmm. Yeah, and kind of going back to what you said about governments jumping the gun a little bit on creating this moratorium, I think that's a very charitable interpretation of what's happening.
Well, I mean, it's to be fair, it's not just governments. I think we've had also investors and the development of the ESG thematic in investing. I think we have a lot of non-specialist investors who automatically look at oil and gas and as a negative thing, whereas I'm not saying that all oil and gas companies, but certainly a lot of them, just as we see in the mining industry, are trying to become more ESG compliant. And, as an investor, surely it's better to engage with the industry rather than blanket cut the industry, causing a huge pass-through effect through the global economy.
So one of the other points in that series was the hidden cost of the EV rollout. So is that incentive structure, just for example, the interest rate incentive structure that we see in the US, for example, geared towards creating an unrealistic demand picture for EVs going forward here?
Well, I think so. There's two issues with EVs. First of all, there's the current cost of EVs. And secondly, there's the factor that there's been an underinvestment in raw material supply for EVs, which is going to have pass-through effects in terms of battery costs and therefore electric vehicle costs. So, I mean, if we start with EVs as they are now, just to give you some numbers. So I think the median cost of ICE vehicle in Europe, so a normal car in Europe at the moment, is about £15,000, £15,000 to £20,000. The median cost of an EV in Europe at the moment is about £30,000. If you include subsidies, that comes down to about sort of £23,000, £24,000. But we are talking about a very material difference in price between an electric vehicle and an ICE. Mm-hmm. And if you look at the bulk of vehicle sales, certainly I think in North America, a large amount of vehicles are sold on contract. And
on a lease.
Europe,
yeah.
On lease, sorry, yeah. You're right, on lease. And in Europe, there's a mixture between vehicle leasing, but more predominant is credit. Mm-hmm. So people just effectively borrow, put a small deposit in and borrow the rest of it. And obviously both of those structures are very closely linked to interest rates. So if interest rates go up, we're in a high inflation environment, as we expect them to do so, then that's going to have a negative impact on the monthly cost of electric vehicles. Then the other issue with regards to electric vehicles, of course, is the issue of battery material costs, and I'm sure we'll probably talk about that later. Mm-hmm. But my contention is that we have already seen a very substantial increase in lithium costs. I think that's going to be carried through all the way through the battery material space. So cobalt prices are up 70% last year, nickel prices are up 20% and are up already this year. High purity manganese prices are going up, graphite prices are going up. So we're going to see an increase in battery raw material prices, which is then going to pass into the supply chain, so to battery manufacturers and then to EV manufacturers. So they're going to have inflation pressure. And of course, the final point, which wasn't relevant at the time when I wrote that article, but is increasingly relevant now, is if your power cost rises, then your cost of operating an EV rises. And, European power costs have gone up, I said 300 or 400% in the last 12 months. So, it's not to a point where your EV costs as much as an ICE to run, but it certainly costs a lot more now than it did necessarily 12 months ago to run it.
Mm-hmm. Yeah, I was thinking of exactly that, considering how much we've seen power costs in Europe go up by, what that translates to in the cost to actually operate an EV.
Yeah, I mean, it's significant. I don't have the numbers exactly to hand, but I mean, it really is significant in terms of the cost of filling an EV up by either 80 or 100%, depending on which EV you've got. So, it is going to make an impact, I think.
So one last point I'd kind of like to touch on here. Why are renewables in their current form not the promised land?
How long have you got? I think the big thing to be aware of with renewables is renewables on their own are what we call a variable power source and not a baseload power source. And if you're closing down coal and gas-fired power plants, those are baseload power sources. And what that means is that you can run them all day, every day. Whereas renewables, straight out, you can only run a solar plant during the day because obviously you don't collect any power at night. And a wind plant, you can only run when the wind blows. So, the situation we had in Europe last year was there were very, very light winds, and therefore we're using a lot more gas than we had done over previous years. So renewables are very much a variable power source. Now, if you connect your renewable plant with long duration storage, pumped hydro or battery storage, then you can make it much more consistent as a supply source in the grid. But realistically, what's happening at the moment is you're closing down baseload power production and you're replacing it with variable power production. And there have been a number of studies done that suggest that if you have more than 20% renewables on the grid, you're actually destabilizing your grid. So you've either got to put in stationary storage or you've got to put more base load in there. Now, a lot of people suggest that nuclear is the solution to this issue of closing down base load production. And I personally believe that nuclear has got a lot of advantages on that side of things. Also, hydroelectric power obviously would be positive as well. But that only works in countries where you have a substantial amount of rainfall and correct morphology to build hydroelectric dams, etc.
Yeah, absolutely. And that grid level electricity storage is still a major obstacle to capturing and being able to use that energy from the renewable sources, right?
Yes, it is. And I mean, the other thing that is very, very relevant to this is the amount of investment in infrastructure that's needed when you talk about building sort of renewable platforms. So I don't think maybe people understand this, but if you look at your average wind or solar plant, on average, they're about a third to a quarter the size of the gas and coal power plants that they're replacing. Mm. And on top of that, where your wind and solar resources are is not necessarily in the populated areas that you're servicing. Mm. So you have to put in a huge amount of infrastructure investment to replace a coal or a gas plant with enough renewable plants to replace that power. So, that on its own is inflationary. And I think probably the market and governments are not understanding the extent of infrastructure investment that's needed. Mm-hmm. I mean, just to sort of give you an idea, I understand that something like 9 tons of copper are needed per megawatt of offshore wind capacity. So that's an awful lot of copper. I mean, that's in the turbines, but primarily it's in the cables that connect the offshore wind farm with the substations onshore.
Mm-hmm. So all of these cost inputs end up making inflation more structural and not necessarily transitory, right?
Yes. And I think that the final point that we should definitely mention as regards to inflation is deglobalization of supply chains. And I think this has been a core aspect that perhaps people don't understand. For the last 20 years, the Western world has effectively been exporting its manufacturing base to China. Mm-hmm. And China has been exporting deflation because they've been able to run their factories and their raw materials facilities at very low return levels and then generate bits and pieces at very low prices. Mm-hmm. That's not going to happen anymore. The Chinese have clearly shown that they have no more interest in producing low-cost materials to export them to the West. They're going to produce their materials for their own domestic consumption. And, straight away, if I then want to open a steel plant, for instance, or an aluminium plant in the Western world, that's going to cost me a lot more, both to build and to operate, than it would if I did that in China. Mm-hmm. So we're seeing, and we will see, a huge increase in the operating costs of the supply chain over the next 5 to 10 years as we have to bring those manufacturing plants back on shore. Our economies have got a lot to offer, but what they don't have to offer is either cheap power or cheap labor. So it's going to cost a lot more to operate in North America and in Europe than it would have in China. And that is going to be another very significant structural driver of inflation.
Excellent, Matt. Is there anything that we need to kind of wrap up there before we move on?
No. I mean, I think that's the core of the story, and I think a lot of central banks feel that inflation is transitory, but we're very much of the view that we are looking at a structural inflationary event which could last certainly for the next decade.
Mm-hmm. So you mentioned copper need as part of that offshore wind program, let's say. Mm-hmm. And you recently wrote an article entitled "What Analysts Are Getting Wrong on Copper." And you aren't necessarily bearish on copper, but just trying to give some perspective on what other materials might appreciate more than copper. So is it possible that most analysts are really overestimating demand for copper going forward?
Well, I mean, that's my contention. And the article is effectively saying, look, why I think nickel is more interesting than copper, mm-hmm. Before all of the copper bulls sort of send nasty bows and arrows in my direction. But I do think there is an issue with copper that a lot of analysts aren't picking up, whereby it has gone through a structural change in demand over the last 10 years. And I first sort of picked this up 4 or 5 years ago when I was working on the sales side. I did a lot of work on the changing nature of the consumer products industry, effectively, and its impact on materials demand. And I'll just use maybe the music industry as an example here. So if we think back sort of 10 years ago, maybe 15 years ago, if you and I wanted to walk around, we had a portable CD player or a Walkman, maybe. I may be dating myself there, but
I had a Walkman too, Matt. Don't
worry. Then, in our house, we would have a video player. We would have had maybe a DVD player. We would have had a CD player in our house and a hi-fi. We would have listened to CDs and to DVDs. Now, accelerate 10 or 15 years to where we are now. We might have an iPod or an MP3 player. I personally do. But most of us are probably listening to music out and about on our phones. Most of us are probably utilizing streaming facilities on our TVs. We don't have a DVD player. We don't have a CD player. We probably don't have a hi-fi. We probably don't even have a radio. All of those consumer goods, which used to be pretty significant consumers of copper, they've gone. Mm-hmm. We don't use this anymore. I mean, in my house, we don't even have a fixed line telephone. We only use our mobile phones, our cell phones. Mm-hmm. So, we have seen a very, very material change in the structure of the industry. And one of the things that comes out very clearly, if you look at copper demand over the last 10 years, and if I back out the COVID-affected years of 2020 and 2021. Mm-hmm. But if you look at copper demand over that time, you can see that there's been a big drop in copper demand growth. And if you back out the impact of China, Western world, and in fact, rest of the world copper demand growth has been flat to negative. Mm-hmm. So it's really only been China that's keeping copper demand growth positive. And if you break out the drivers of that, it's primarily been the fixed asset investment event in China. And we certainly have seen a very pronounced slowdown in copper demand in China in the second half of the 2010s. And that corresponded with a very significant slowdown in the fixed asset investment spending in China in the second half of the 2010s. So now when I look at the situation now, and I see people calling for a further slowdown in the China property market, I'm afraid that slightly gives me the willies. And a lot of people come back and say, well, there's been huge underinvestment in the infrastructure story in the US, in Europe, and in North America over the last 10 years. We have to go back and spend on that. But as I laid out in the article, infrastructure spending in the Western world, for instance, will have to treble to offset the magnitude of the slowdown that we'll see in the Chinese fixed asset investment event. And that's just not going to happen. So from my point of view, I still think copper will be a positive growth event. Copper demand will carry on growing. Mm-hmm. And obviously you've got the renewables underpinning that. But I don't think it's going to grow as fast as many analysts are suggesting.
Mm-hmm. So as part of your analysis, Matt, you broke out the demand from China. Is it possible that we see the growth in the rest of the world kind of pick back up as we onshore some of these manufacturing facilities again?
I think it's likely that we will see, stronger demand growth in the Western world. I mean, there'll be a delay. So, if I'm going to build a factory, I've got to get planning permission, et cetera, to build that factory. So it's probably to take about 2 years or so before the construction of those factories will actually take place. Mm-hmm. And that's one of the reasons I'm a little bit negative on copper, because in the near term, I just don't know what the demand growth catalyst is going to be. In the longer term, I can see the demand growth. It'll be, resiting these factories in the Western world. It'll be building out the renewables, certainly towards the latter end of this decade. But in the next 2 to 3 years, I'm a little bit nervous because I don't see, where the demand is coming from. And most analysts are calling for something like 4% supply growth in the next couple of years. So that's why I'm a little bit wary about the copper demand as opposed to the nickel. And I think the other issue that obviously is very close to my heart is this issue of analysts overestimating the impact of the EV event on copper demand. Mm-hmm. And you hear a lot of numbers being shot around, which basically seem to suggest that electric vehicles use 4 times the amount of copper that normal vehicles, ICE vehicles use. And while that was true in 2016, 2017, when most EVs were developed from ICEs with just battery systems added in, it is not true now for bottom-up developed electric vehicles. And it's probably close to 2 to 1 now, and over the next 3 or 4 years will move down to about 1.5 to 1 or possibly to equal levels. And I think a lot of analysts are overstating copper demand from electric vehicles. And on my numbers, they could be overstating it by about 1 million tons to 1.5 million tons a year. So that's a really substantial impact.
Mm-hmm. Yeah, and that's just kind of goes along with the evolution of the design of EVs starting to really optimize for efficiency, right?
Yeah, and I mean, people who maybe are not that close to the industry don't see the changes that are happening in the industries. I mean, one of the biggest users of copper in electric vehicle is the battery management system. So that's the system that's in place basically to manage the environment of the cells in the battery to make sure they work optimally and to avoid some of these nasty issues that we sometimes get with electric vehicles like thermal runaway and whatnot. Mm-hmm. But, increasingly now those systems, one, are wireless, or two, because of changes in battery chemistry, they don't, like for instance, LFP, lithium iron phosphate batteries, they don't have to be as involved as perhaps they've been in the past. So we've seen a huge drop in the usage of copper in these battery management systems, which is just not really being picked up by a lot of analysts.
So what is a growing segment of the copper market to you, Matt?
I think renewables. I mean, there's no getting away from the fact that renewables is going to be a major driver of copper demand. But the problem is, certainly in the early years of this decade, the incremental growth is not going to be enough to offset the slowdown in other areas of the demand environment. In the latter years, I think that the incremental growth is going to be much higher. But in terms of what we've got now, I don't think it's going to be enough to offset certainly the increase in supply that a lot of people are forecasting.
So we've really talked a lot about the demand side, but when we think about the supply side, Matt, is the copper shortage, let's say, as bad as we have been hearing?
It's a really difficult one because obviously high prices tend to result in more supply coming into the industry, and prices have been ticking up over the last year or so. Most analysts are forecasting something like a 4% year-on-year growth this year and next year. Beyond that, there's no doubt that it is much more difficult to mine copper now than it was 20 years ago. It's much more difficult to find high-grade copper deposits in areas where it's easy to mine. There's a lot of geopolitical issues, particularly in Latin America, which are forcing investors to look elsewhere. So I think the mining of copper has become more complex. It's become more expensive. It's become more difficult to invest in. One of the areas that I look at very closely is scrap supply. And I think that perhaps a lot of analysts underestimate the amount of material that would be available for scrap as prices go higher. But I don't think there's any getting away from the fact that over the long run, it's going to cost more to mine copper, which is going to force prices up. I mean, grades are much, much lower. Even when I was looking at copper projects in the early noughties, the sort of grade of, for instance, a porphyry deposit in Latin America would be 0.6, 0.7. Now it's 0.3, 0.4. So, the actual business of mining copper is much more difficult than it used to be. There's no getting away from that fact.
Mm-hmm. So as you already alluded to, Matt, that, all of these factors make you much more, let's say, bullish on nickel instead. So remind us of the different types of nickel deposits and what types that are best suited for battery manufacturing, and let's say the rarity of those types of deposits.
Okay, so so nickel is a core component of what we call ternary batteries. So NCM or NCA batteries, which are widely used in the Western world. And the attraction of this type of battery chemistry is it has quite a high energy density, and therefore it's got quite a high range. Now, what we've seen over the course of the last sort of 5 or 6 years or so has been this push to try and minimize the amount of cobalt that's in these ternary batteries. So 7 or 8 years ago, an average ternary battery would have something like 30% nickel, 30% cobalt, and 30% manganese. That put a lot of pressure on cobalt supplies, and the cobalt price actually went through the roof. And on top of that, as OEMs, auto manufacturers, become very much more focused on ESG, there is this issue, obviously, that a large amount of cobalt in the world comes from the DRC, a lot from artisanal mining, and with not very strong human rights record, should we say, in a polite way. Mm-hmm. So there's been a lot of pressure on the industry to reduce the amount of cobalt in batteries. And what we're starting to see now is the emergence of these, or what we've seen over the last couple of years is emergence of high nickel batteries. So the current fastest growing nickel battery chemistry in the world is what we call an NCM 811 battery. So that's 80% nickel, 10% cobalt, and 10% high purity manganese. And obviously that uses probably 2 and a bit times more nickel than your NCM 333 cost would use before. So that's been much more intensive. But as you take cobalt out of the battery, cobalt has a big stabilizing effect on the battery. Mm-hmm. So it then becomes very important that your nickel is very pure as a product. And that means that only certain formulations of nickel are viable basically to provide the raw material for batteries. And we split the nickel market into 2 products, class 1 and class 2 nickel. And only class 1 currently is viable to produce battery grade nickel. Now, there are a number of technologies under development that would take potentially class 2 nickel, but they haven't been proven on a commercial basis yet. One of them is on the cusp of commercial development. Anyway, so if we split nickel assets globally up, there are 2 types of ore bodies. One is a nickel sulfide ore body, and the second one is a nickel laterite ore body. Now, your nickel sulfide ore body is pretty similar to, for instance, your copper sulfide ore body, or other such ore bodies that are mined. This tends to be quite a high grade product, or historically has been quite a high grade product, maybe a couple of % nickel in situ. And it's very easy to concentrate that material, and then you can smelt that material into either nickel briquettes or nickel metal, which sits on the London Metal Exchange. Now, the second quality is a laterite nickel, and there are different types of laterite ores within that. So there's one particular type which can be upgraded to high quality nickel using a process called high pressure acid leach. Now, high pressure acid leach was all the rage in the 90s. There was huge investment. It was a new thing for nickel. Billions of dollars were spent on it. And I'm not going to say it was a failure, but it certainly wasn't a success. And what was found was these projects took a lot longer to develop than planned. They cost a lot more to develop, and they never really hit their intended capacity utilization levels. And this has been an issue right the way through. In fact, only 2 projects in the world ever hit their intended production levels, and it took them a lot longer than planned to get there. Now, the big issue in nickel is that there's been a lot of investment by Chinese companies in Indonesia in these high pressure acid leach projects, and this has effectively capped the nickel price. The issue with these high pressure acid leach projects is there's a lot of waste material, and it's quite acidic waste material. Now, a number of these mines around the world actually pump this material offshore and dispose of it in seawater. The Indonesian government turned around last year, I think, actually, and said that this is not viable. But a lot of these Chinese project developers had proceeded with these projects before they got the environmental permits through. So we now have a situation where these mines are under development. In one case, it's actually built, but they have to find a new way to dispose of the tailings, which probably involves dry stacking them, which means a complete re-engineering of the tailings disposal plan, which means that these projects are not going to get into production as planned, and they're not going to hit the planned production targets. And that's one of the reasons why I'm a little bit more bullish in nickel in the medium term, because I don't think a lot of the supply that was expected in the market is going to come on. Now, out with the laterite, I talked about sulfides. The bulk of nickel assets that are in production are quite high purity sulfide deposits, but clearly there's not enough of sulfide material to come into the market. And I personally believe some of the lower grade sulfide ores in North America, potentially in Canada around the Sudbury area and maybe up in Manitoba, may be viable for development. If you look at them in, for instance, copper equivalent terms, yes, they're low grade in nickel terms, but they're certainly very viable to develop in terms of copper equivalent. And it's not really about the in situ grade, it's about how much it costs you to actually concentrate the ore. And these ore bodies should be very, very viable to be mined for nickel sulfide. Added to which, obviously, they're sitting very close to a huge center of EV demand in the US and Canada. So, it makes a lot of sense as well. And on top of that, the smelters in this area are driven by hydroelectric power, which is a lot less carbon intensive than a lot of the smelters in China. So, that there's a lot of potential, I think, for sulfides, but also for lower quality sulfide projects in North America.
Mm-hmm. So, Matt, we saw a collapse in nickel prices about a year ago. Why was that? And why does it not affect the market as much as it initially did?
Well, I talked about this technology for developing class 2 nickel into battery grade nickel. Casting your eye back on the nickel market in the mid-noughties, one of the reasons why nickel prices originally corrected in the mid-noughties, apart from this little event called the global financial crisis, was the development of a new technology by a Chinese steel manufacturer called Tsingshan, which invented this processing solution called nickel pig iron. So it was able to take low-grade laterite nickels and smelt this at high temperature to produce a sort of nickel iron alloy, which could then be used as a raw material in stainless steel furnaces. Now, Tsingshan struck again at the beginning of last year, and they claim to have invented a process that can change nickel pig iron into nickel matte, which can then be used as a precursor for battery-grade nickel. Now, the first shipment of this material left Indonesia a couple of months ago, last month actually, and we will find out very quickly whether it's commercially viable to upgrade this material. From my point of view, I have doubts about this process, primarily because it basically uses double smelting. So it's what we call a pyrometallurgical process, which means it uses heat, and basically the laterite needs to be smelted to produce the pig iron, and then the pig iron needs to be smelted to produce the matte. So it's a double pyromet process, which is very energy and therefore CO2 intensive, and a lot of waste as well. So my view is that the process is not really going to be acceptable to Western world OEMs as a solution for electric vehicle batteries. We're seeing a lot of pressure from Western world OEMs at the moment on the supply chain in terms of minimizing CO2 production and making the supply chain as tight and as environmentally friendly as possible. So I can't see this process being acceptable. And if we're just talking about the NCM that goes into Chinese vehicles, then that's a very small percentage of the market. So I don't really see this process offsetting a huge amount of class 1 nickel demand, because it won't be acceptable to OEMs effectively.
Mm-hmm. So are nickel inventories at a reasonable level to support demand at this point, Matt?
Well, I mean, this is one of the reasons for my call on nickel as opposed to copper. We've actually seen a very substantial reduction in nickel inventories over the last 6 to 9 months or so. On my numbers, they're now just above 10 days of supply, having been sort of 20, 23 days of supply previously. So that's a huge drop in inventories. And if you look at copper inventories, they're actually on the rise at the moment. Now, if we back out the reason for nickel inventories to be lower, there's no getting away from the fact that there was a constraint on supply last year. So we had the strike at Sudbury, the Vale strike at Sudbury, and we also had a mine out also at Sudbury, which impacted nickel production. We had a number of other issues. We had a water incursion at Norilsk, which impacted production, and also we had quite poor production from some of the Western Australian nickel mines last year. So, production last year was constrained, but on my numbers, it was constrained by about 70 to 100,000 tons, and nickel inventories fell by over 150,000 tons. So certainly some of the fall in inventories was due to greater demand, which I think came from electric vehicles. And certainly we're seeing that demand continues to accelerate. So we saw very, very strong import demand into China for refined nickel last year. And we also saw a 5 times increase in nickel sulfate imports into China. And nickel sulfate is the precursor for it's the key precursor for battery grade nickel production. So, for me, we did see an impact on supply, but we saw a bigger impact in demand. Mm-hmm. And I'm always reminded of the initial signs of the super cycle event way back in 2001, 2002. And the first thing we knew about that huge demand event was inventory started to fall. Inventory started to fall all over the world. And, this very much reminds me of what we saw then. So, this is the final piece in the jigsaw informing my, more bullish view on nickel and on copper.
Mm-hmm. So when we compare nickel to lithium, is the story much the same or opposite as nickel?
The story is the same in terms of the fact that there's a secular demand event. Mm-hmm. Where the story is different is in terms of the market size. If we look at the increase in demand for nickel over the next 10 years, I expect the market, so that's including the stainless steel market for nickel, mm-hmm. to double or perhaps go up by 1.5, 2.5 times. The lithium market will go up by a factor of 10 times. So it's an order of magnitude difference in terms of the magnitude of the event. And in the lithium side, we see production hugely constrained. I mean, production is already constrained, and it's just getting worse. A lot of the production additions for this year were due to come on in Western Australia. Because of COVID restrictions, Western Australia has effectively been closed to visitors for the last 2 years. Nobody's been able to get in. That's delayed a huge amount of these very substantial production additions that we're expecting for this year. Now we've got a few small additions due in Latin America, but nowhere near enough to replace the demand that we're expecting. And I mean, we talk about inventories falling, from everything that I know from my contacts in China, you can't beg, borrow, or steal 500 ton of lithium inventories at the moment. So you talk about nickel inventories being about 10 days of supply. Lithium inventories are about 0 days of supply currently, and that's the reason why we've seen this huge move in prices. When I went out in December and said I thought the lithium price would double to $60 a kilogram, everybody said I was nuts. Mm-hmm. But it hit $60 a kilogram in February and has blown right past that level. So, we very much. I can genuinely say I don't know how high prices could top out at, because the other issue that we have in lithium is that, normally in a market where prices were rising, you would have a level where the industry bulks at high prices, where you see demand elasticity. But in lithium, we have a situation whereby the industry isn't driving the EV event. Governments and environmentalists are driving the EV event. So we don't know at what level the industry would bulk at, or even whether the industry will be able to bulk at the higher prices. So it really is, it's a very interesting situation in lithium at the moment.
So when we think about this move towards the green energy future, Matt, ESG requirements are a main focus of moving towards this goal. But where could these ESG regulations actually hamper production of certain types of cells from the production side?
Well, we're certainly seeing ESG hamper raw material development at the moment. I'm aware of a number of nickel, copper, lithium projects in the US, which are in development hell at the moment because of pressure from environmentalists. I know a number of developments in Europe which are under similar pressure. Rio Tinto had the JLAR project in Serbia. That the license for that was cancelled by the government because of pressure from environmentalists. That there seems to be a situation which is, we really want this material, but if you're going to mine it in our country, we don't want it so much. That's not a great situation for the industry to be in. So, there are countries in the world like Australia and Canada and Brazil where the governments and the population are friendly towards the mining industry. But we can't just rely on Australia and Canada and Brazil. If we genuinely want these resources, we need government support for the mining industry in all of these countries. And, I'm a geologist by training, and I'll be realistic that the mining industry hasn't done itself any favors in the past. But certainly, there are a number of people in the mining industry, a number of companies that are working really hard to improve their environmental, their social, their governance. And I kind of feel that the mining industry is not being given its dues really by politicians and by environmentalists. And that it's really endangering the energy transition. Just to give you an idea, I was at the top of consensus for my EV sales forecast for the last 2 years. I'm now at the bottom of consensus. And the reason I am is because I've taken my EV sales forecast down because there will not be enough lithium to hit my EV sales forecasts. And that's the situation that we're in. If we cannot get these projects into production, there will not be enough raw materials to supply these projects. So there will be no energy transition without investment in raw materials. And there's a very unfortunate conversation going on at the moment whereby a lot of politicians, environmentalists are focusing on recycling. Recycling is important, but without investment in primary production, there won't be enough material to recycle.
Right.
So, it's governments need to understand what's going on. The OEMs need to understand what's going on, and environmentalists need to understand what's going on and understand where their red lines are. If you want to decarbonize, you have to invest in primary metal production. If you don't want to decarbonize, then, let's go back to the status quo ante.
So as you mentioned the OEMs there, Matt, do you think that we could ever see some of these automakers enter the commodity market and buy raw product producers to really secure their supply chains?
To tell you the truth, I'm waiting for it to happen. Many of us in the industry have been talking to automakers for several years about this now, and I think there has been a certain amount of head in sanditis from the automakers. And also a lack of research. A number of research bodies have been implying for many years that there's plenty of lithium in the world. It's not going to be a problem. They've been wrong. The automakers haven't done their own research on this. We've recently had a number of automakers acknowledge for the first time that this is an issue. The CEO of Mercedes came out a couple of weeks ago and said that. I think Tesla's procurement people are aware of it. We're starting to see actions in terms of securing offtake agreements from a number of automakers. But in my view, offtakes aren't enough because they don't give you a guaranteed price. They just give you a guaranteed supply. And in fact, a lot of the offtake agreements were are with projects that I regard as slightly marginal, i.e. they're using experimental technology. So, for me, if I was an automaker, would I want to be spending $65 a kilogram for my lithium carbonate, or would I rather buy a mining operation or a brine operation and pay $5 a kilogram for my lithium carbonate? For me, that's a no-brainer. But for the automakers, clearly it's not. So I think, they have been wary about going upstream, but it makes sense for automakers to go upstream over time. And I wouldn't be surprised if we see more activity in that area going forward, should we say. But it'll be probably over the next couple of years rather than over the next couple of months. I think the problem for the automakers is they're used to dealing with mature industries, like steel, like aluminium. They can turn around and say, I need another 5,000 tons, or I need 5,000 tons less this month. But the lithium industry, the graphite industry, high purity manganese, etc., these are not mature industries. And the magnitude of the demand growth that we're seeing means that we need huge amounts of capital applied into these industries, and we're just not seeing it at the moment.
So when we take all these raw product input costs into consideration, do we see EV businesses becoming profitable, or is it possible that the fall in battery prices that we've witnessed over the past 8 to 10 years could reverse and actually become more expensive again?
Oh, it's reversing already. So third and fourth tier Chinese producers, they raised their battery prices at the end of last year. We've seen a number of Korean battery makers raise their battery prices this year. So that fall in battery prices has ended, and it'll be upwards from here. And it's starting to cascade through the industry. So, we will see pressure on automakers from higher battery prices, and by the way, from higher steel and aluminium prices over the next year for certain. And I don't think that's being recognised by analysts at the moment. Yes, there will be a lot of pressure, I think.
So what other raw products do you see an opportunity to invest in here, Matt? Are the graphite projects interesting to you?
To tell you the truth, practically everything in battery materials is interesting. I do think graphite is very exciting. The bottleneck for me in the graphite side is more in the midstream than in the upstream, in the anode production outside China. That's where I see the primary opportunities in that business. High purity manganese is a hugely misunderstood business. People look at manganese and they go, there's loads of manganese in the world. And there is loads of manganese in the world. But the problem is the amount of manganese in the world that's viable for upgrading to battery grade is a vanishingly small amount. So the number of projects that are out there that can manufacture high purity manganese for battery, I can count them on the fingers of one hand. So we really are talking about a very, very small amount of suitable projects that are currently in development. I have to say I'm less excited about cobalt, just in terms of the fact that there are moves afoot to reduce the amount of cobalt in batteries. Having said that, I do think that there's an opportunity for cobalt demand still to double in the next 4 or 5 years. It's just that it's not going to go up 10 times like a lot of these materials. So, cobalt prices will be positive, cobalt demand growth will be positive. And from an investor's standpoint, we're actually starting to see an emergence of a sort of next tier of cobalt producers coming in to the market now, so that there's actually investable companies out there whereas there haven't been for a number of years. So I think cobalt is interesting, but for me, lithium, nickel, high purity manganese, and graphite are a little bit more exciting for a through the cycle investment, should we say?
Mm-hmm. Excellent, Matt. Well, I really appreciate you kind of giving us a real overview on all of the battery materials as you put. Of course, your website and all of your articles, your blog posts here that we talked about today are available at batterymaterialsreview.com. Matt, anything else you'd like to add before we wrap up here?
No, that's great. Thanks very much indeed for the invitation. Appreciate it.
Excellent, Matt. It was great to speak with you today.
Cheers.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.